Welcome, and thank you for tuning in. You're listening to the Beyond 50 radio program. I'm Daniel Davis. On the program today, we're going to be joined with Charles Whelan, and he's been on the program with us before as we talked about his book, Naked Economics. Today we're going to be talking about the vast and often arcane machinery of the modern financial system, the, quote, plumbing that keeps the fiat money flowing, revealing both the extraordinary efficiency and the utility of the banks and other players when things are running smoothly, as well as the devastating havoc caused when things go awry. He's also going to talk about banking blow-ups throughout the history of the world, and he's joining us here on the Beyond 50 radio program today to talk about naked money. Charles, thank you for joining us here on the program.
Hey, it's great to be with you again.
You know, it's one of these subjects that a lot of people are talking more and more about, you know, the banking system and how we need to change all this. Tell us about a little bit about your newest book.
Well, money, as it's construed in the title, is really three overlapping things. The first is money itself, which is not wealth. Your house is wealth, so are the bills in your wallet, but only one of them can you take to the grocery store and use to buy things. So money is what we use to make transactions, and we can drill down on the history of that and the strange things about having money that's not backed by anything. And then there's the banking system, which of course incorporates money, but that's about lending and borrowing and the complexity and vulnerabilities associated with that. And then there's the last piece, which is central banking, which is the institution that we've created to look after the first two, obviously with mixed success over time.
Isn't that the truth? A lot of people begun with banks. I've even, seen situations where they're saying, what is it with banks in the first place? They really don't do anything.
Well, here's what's so interesting. They do something really, really important. It just happens to be a little dangerous when things go bad. Banks, and by banks I mean all the things that act like banks. Sometimes they're insurance companies, sometimes they're investment banks, and so on. But really what they're doing is intermediating savers and borrowers. And at every point in the life cycle, one of us is going to be one or the other. So right now I'm about to go from being a saver to being a borrower when my daughter heads off to college. But when I'm a saver, I want to take my extra capital, give it to somebody who can use it, and charge them a rental rate for that. It's good for me because hopefully it's going to be safe and I'm going to earn a return. It's good for them because they can do something they couldn't do without borrowing my capital. So the banks and other financial intermediaries do this really, really important thing. It's essential for business. It's essential for smoothing consumption, retirement, investing in human capital, and so on. The problem is that most of those institutions borrow short-term. So if you think about a traditional bank, you can go get your money this afternoon if you want it, and they lend long-term. So they're investing in property and education and restaurants. And if we all go in this afternoon and want our money back, they can't. Even a solvent, healthy, safe, legal institution can't get it all back right away. So when we collectively panic, anything that looks like a bank is particularly vulnerable.
Now, it's really interesting that at times, especially when people are under financial duress, that we'll tend to look at banks as being the bad boys. Why do we tend to take those kind of positions when maybe things aren't going so well for us when it comes to money?
Well, I think there's a line in the book that we all love bankers until we want to kill them with pitchforks. And that's kind of been the history of finance. When times are good, banks are what facilitate the go-go period. When property was going crazy in 2004, 2005, it was the bank that was willing to give you the loan without a whole lot of documentation, and that made you really excited, either because you bought a bigger house than you should have or because you were speculating in real estate. So when times are good, we kind of ignore the bankers and think we're geniuses. And then when times go bad, either the banks want their money back or they're more parsimonious about lending, which we don't like, or if things go really bad, they fail. And when banks fail, there's a cascading effect. It affects other healthy businesses, and they tend to be the kind of rot in the system that can spread these panics further and wider.
Now, it's interesting I use the term fiat currency or fiat money. Tell us a little bit more about that.
Well, fiat currency is just a fancy way of saying that we have paper money that is backed by the legitimacy of the government. We, by the way, in every other industrialized country, whether it's the yen or the euro or any other currency, And it's not backed by much more than that. That's it. So if you take your $20 bill to the Treasury or to the Federal Reserve and start waving it around in the lobby, they're either going to look at you quizzically or they're going to ask you to leave the building. This is not how it's always been. I mean, if you go back far enough, hundreds and hundreds of thousands of years, we've always had money, but it tended to be some commodity. So it might be rice or salt or leather or livestock or tobacco, which is easier to get your mind around because you can use it to trade. It's a pretty good store of value, so if you want to store your wealth, you can keep your tobacco dried in the basement and so on. Then we move to a period that's also easy to understand, which is, okay, tobacco is kind of inconvenient, and there are actually grades of quality, so it's kind of harder to figure out how much it's actually worth. Let's go to something uniform like precious metals. So let's use gold and silver. If we weigh it and we can figure out what's pure, that's easier, but it's kind of a pain to carry around. So why don't we put our precious metal in a vault or a bank, and they'll just give us a certificate saying that we have it. And that became paper money backed by commodities, usually some precious metal. That's easy to understand. The crazy part is this last piece, when during the Great Depression, Franklin Roosevelt took us off the gold standard, and we were left with just the money.
Now, that's an interesting story by itself for, when you go back to realize that we not only got off the gold, but we also went into what are known as Federal Reserve notes. In other words, the Federals decided, go ahead and take our word for it that if you have this, you're good for it. But when you look back in history, especially the big banking failures, let's say, there was the famous story of the lady who was wheelbarrowing a big load of money in a wheelbarrow, and it turned out that she got the wheelbarrow stolen from her, but the money was still there left on the sidewalk. And you realize how we tend to look at the value of things, especially when it comes to money. Anybody who's seen, for instance, movies that involve situations in Las Vegas where all of a sudden, for instance, like the movie Casino, where, what is it, I'm trying to think of, Stone, the actress Stone, who was throwing the chips all over the floor, and everybody's diving for these things, It's just like their very life depended on it. It's just really interesting how much value we put into money when it really is the value that we get for our money, so to speak.
Right, and whether you can, at the end of the day, exchange those little pieces of plastic chips for something worthwhile. I got a lot of plastic chips in my house. They're just plastic. And whether you can exchange that paper for something. By creating a fiat currency, we're bestowing an enormous amount of trust on the authorities who overlook that currency. Because it's not backed by a commodity, there is no natural limit on how much of it you can produce. Actually, I should qualify that and say, when some governments get ferociously irresponsible, they run out of high-quality paper and ink. That's the constraint. But other than that, you can just turn on the printing presses and start paying your amigos and stuffing your own vault. And, of course, that's like any other supply and demand situation where you've got this extraordinary supply of paper currency chasing the same basic amount of goods. And that's how you end up with what I have on my desk, which is a framed $100 trillion bill from Zimbabwe, which, like the Weimar Republic and a whole bunch of other irresponsible governments, printed money with reckless abandon and ended up with the natural byproduct, which is hyperinflation.
Now, I've had an interesting experience back in the 1980s as I served in the United States Navy. We had the opportunity, my very first place overseas, if you will, or outside of America, happened to be in South America, in Brazil. And it was interesting to go in and to convert money into their particular form of currency, and it just seemed like you had thousands of dollars in your hands. Maybe you exchanged $40, $60, $100, but all of a sudden you were looking at bills with a lot of digits on them. And it was interesting how much you were able to purchase in Brazil for so little American dollars, too. $20 could get you a hotel room. They could get you 3 meals for the day, and certainly drinks. In America, you'd be lucky if you could just have the drinks and maybe something to eat. Then we went over to Europe, and I think France was the first place we had the opportunity to visit. I realized, our money isn't that much more valuable here than it is in the United States, so I was getting a lot less. And so that neat romantic period that I enjoyed overseas when I was in Brazil was much more romantic there than it was in France. And all of a sudden, it just wasn't as much fun anymore. And it's really funny how that changes from country to country.
The whole concept of exchange rates is a very curious phenomenon that's covered in the book. And, of course, the dispute between the U.S. and China over whether if a country like China manipulates its exchange rate, then all of the goods it's selling to its export markets start to look like the stuff that you were buying in Brazil, really, really cheap. Like, look how far my dollars can go. And, of course, that's great for American consumers buying Chinese goods. It's not so great for American companies trying to compete with those Chinese products that may be artificially cheap just for currency-related reasons.
Now, the big talk that we seem to be hearing a lot about is that of central banking. One place where they make the decisions about the value of what currency should be, and to keep that straight. How do you see that in the future? Is this something they're ever going to, I guess, get right?
Well, we're getting better at it, which isn't to say that we're perfect. But if you think about 2008, for as bad as it was, we arguably did not repeat the mistakes that we made in 1929. And that's not an accident. I would argue that we got lucky in 2008 because the guy at the head of the Fed at the time, Federal Reserve, was Ben Bernanke. And as coincidence or good luck would have it, Ben Bernanke was a scholar of the Great Depression and, in fact, had spent his career studying the mistakes that the Fed and other authorities arguably made in the 1920s that made the 1930s so bad. One of them was clinging to the gold standard. And if you think about what you need to do in a crisis, you need to provide a lot of liquidity to your banks so that you keep healthy banks healthy. And you need to stimulate the economy with as low interest rates as you can possibly provide. The gold standard was a hindrance to both of those things. You can't just provide liquidity for the banks if you don't have the gold. And authorities were worried about keeping interest rates low because they thought that gold would flow out of the country, and we're trying to protect our gold stash. So it is fortunate that we were off the gold standard when 2008 came along, and it's also fortunate that Bernanke recognized the things that had to be done in a crisis. Now, we can talk about the political blowback and people who did stupid things who got bailed out as a result and so on. But fundamentally, you do have to stop a banking panic of any kind before it infects the whole global financial system.
Now, how well do you think that situation of 2008 was handled by our government?
Well, you have to start before 2008. So one place where the Fed and other regulatory authorities clearly fell down was on lending standards. So a lot of what went wrong later on was that people were making bad loans, and then those loans were chopped up into financial assets that were opaque and ultimately toxic and so on. The Fed has the authority, had and still has, to crack down on lending standards. And I think there's a pretty strong case to be made. I think Ben Bernanke would also say this, as did the Financial Crisis Inquiry Commission that looked at 2008, that the Fed was too benign prior to 2008. Coming out of the Greenspan years, there was this belief that markets would kind of fix themselves. And what we learned is there was a lot of predatory lending, a lot of irresponsible borrowing. And I think if the Fed and other regulators had tightened down on that, much of what happened later would not have been nearly so bad. You still would have had a correction in the real estate market, but people wouldn't have been so leveraged and exposed. I think the Fed is probably not responsible for creating the bubble in the first place. There was a lot of debate about whether the Fed kept interest rates too low for too long. People still debate that, but I think ultimately it's on us for getting carried away with the real estate market. Interest rates fueled the flames, but probably didn't cause that problem. Once we got into the crisis, I think that... Go ahead.
Oh, no, I was going to go ahead and finish what you were going to say because there's something that's really interesting about that whole thing. But anyways, you were saying...
Yeah, I think once we got into the crisis, the Fed, I believe, deserves really good grades. They took interest rates as low as they possibly could go. They provided liquidity not just for the banks, but for all kinds of other financial institutions that they had the authority to help out. And when I last checked, when I was finishing the book, not a single one of those Federal Reserve loans had gone bad. So, TARP, which came out of Congress, is a different thing, but in terms of Fed lending, against good collateral, which it's supposed to do in a crisis. That's what a central bank is supposed to do. They did exactly the right thing. When interest rates got near zero and they weren't doing enough, that's when we got the 3 rounds of quantitative easing, Q1, Q2, Q3. They all were designed to lower interest rates, although longer-term interest rates. And you don't know the counterfactual, so it's hard to know exactly how well they function, but the evidence I've seen suggests that they did bring down long-term rates, and that helped the recovery. So in the crisis, once it was underway, I think the Fed did yeoman's duty in terms of keeping it from getting worse than it might have otherwise.
Now, what I was going to talk about is you were saying people were going in and they were getting mortgages that really most people couldn't afford. And I find that interesting because there's some people that I knew around just after that time talking about how they need to, end the currency system and they need to go on to a bartering system. We need to move away from banks and banking. And I find it interesting that people who tend to talk like that the most were people that didn't seem to be fiscally responsible in the first place. As though, well, if we get rid of banks, that's going to make your life better. Really? What about your responsibility when it comes to being financially literate, so to speak? I guess is the best way to put it.
Yeah.
What do you usually say to people like that? Because, banking and money, they kind of make sense because really when it comes down to it, as much as people like to believe they'll keep their word, which is really what the barter system is based on, that generally we don't tend to, and we come up with a rational excuse as to why. And the same thing happens in money and in banking. You go in and say, loan me this money, I'm good for it, and then all of a sudden you don't pay, and then you find yourself deciding to go into, let's say, bankruptcy court so you never have to pay it and start all over again. And you're the one that's talking about how the banking system needs to end.
Right. I mean, I think we can concede that bankers made a lot of silly mistakes in the run-up to 2008 and still make a pretty compelling case that we need banks for all the reasons I said at the outset, which is this is the best intermediary we have for matching buyers and sellers. If we don't have that intermediary, then half the kids in America aren't going to be able to go to college because they won't be able to borrow to do so. You'll be able to buy a house when you're about 65 years old, when you've saved up all the money and go buy it in cash. So it doesn't make any sense. We need to make the bankers behave more responsibly in the good times so that they don't cost us so much in the bad times because of this just inherent frailty of the banking system. But your point is a good one. The chain of causality in terms of bad behavior in the run-up to 2008 is long, and it begins with irresponsible borrowing. You can't have everything else that happened without people borrowing too much. And when I say borrowing too much, it's not just that they thought they couldn't pay back the loans. Nobody would do that. It's in a lot of cases they thought they'd be able to pay them back if the price of housing kept going up as it had been, which was an unrealistic expectation. But of course, you had people who were complicit in that process. You had the mortgage lenders who were shoveling money at irresponsible borrowers, and you had the bankers who were providing the capital only because they would then turn around and sell the loan. But then you had the investment bankers who took those loans, chopped them up into small, confusing pieces, and made securities out of them. And then perhaps most reprehensible of all, you had the ratings agencies that slapped a AAA rating on these opaque, ultimately toxic assets. And that takes us pretty much up to the crisis. But, if you remove any chain in that long, sad story, then the rest of it doesn't happen.
Now, there's a lot of talk, and I think it's actually starting to happen where currency shifts to the digital, and we're talking about, for instance, things like Bitcoin. But it seems that we've been so entrenched with this ideal of paper physical money. How do you see that actually happening? Will it evolve? Do you think it will actually begin to work?
In terms of replacing physical money?
Yes.
Well, I think there are two things to sort out here. One is whether cash goes away, and the second is whether the dollar goes away. They're not the same because you can have the dollar and just use it electronically. And I think that's probably the direction that we're going. I mean, already you see that more and more people just charging things or using their phones or Starbucks cards or those kinds of things. We're still carrying around cash, but we're using a lot less of it than we used to. And with technology advancing, there's no reason to think that trend's going to reverse itself. But the important thing to bear in mind is, for all of those transactions, the dollar is still the unit of account. We may not be using cash, but we're still keeping track of how much we're spending in dollars. The Federal Reserve is still protecting the value of that dollar, whether it's electronic, on a check, or on cash. And I just don't see that going away anytime soon.
Well, there certainly is a lot of power when you put a 20 in somebody's hand and ask them to do something, isn't there, versus a digital agreement.
Well, yeah, and when people complain about paper money not being worth anything, I say, all right, well, open up your wallet and give me all that worthless paper then. I'll take it.
Oh, that's too funny. You know, when you're out lecturing, what is the most common question that you find people asking you when it comes to naked economics?
Well, there are a couple. One is there's still this intuitive belief that the gold standard must be better than what we're doing now. And the idea is, in most of life, having something worth something is better than having something worth nothing. And how could it possibly be true that having a currency, a paper currency backed just by kind of the pledge that, hey, we're going to keep that worth something, is better than being able to go somewhere and actually get some gold or silver? It's intuitive, but as I point out in the book, it's also intuitive that when your crops fail, you should go burn witches. Or neither one of them turns out to be correct. The gold standard, for reasons I already talked about with regard to the Great Depression, actually can be a real impediment to dealing with financial downturns. It really limits your ability to lower interest rates and reinvigorate the economy, makes it harder to support the banks, both of which are really important. It's also true, I mean, the kind of people who espouse these ideas tend to be very patriotic and nationalistic and so on. You ought to point out that the bulk of the world's gold reserves are currently in China, Russia, and South Africa. And who in the world would turn over their monetary policy to countries that are, at best, not in sync with our views, and at worst, may have some antagonism? So there are a whole bunch of reasons that the gold standard doesn't make sense, but intuitively, people seem to cling to the idea that that would somehow make the finance system work better.
Now, taking a look at what was happening in Greece here in the last couple of years and the idea of the euro, you point out in your book that this had weaknesses from its very beginning. You know, how do you see all that unraveling there?
It is interesting. This is one of those cases where economists at the time of the currency union were pointing out there were problems. This is kind of like somebody at the wedding saying, you know, I'm not sure this is a great match. And the reason they were saying that is there are certain conditions that are necessary for a currency union to work. One of them is you need relative mobility across the zone around labor. So if you get a recession in one part of the currency zone, people can move to places that are healthier. It's best if the currency area also shares a fiscal and regulatory policy. And then the zone will probably work. And if you think about the United States, which is about the same size as Europe in terms of population and geography, the United States has those conditions. If Michigan has a recession, people can it's not easy, but they can move to Arizona or Florida, places that are doing better. We have a fiscal policy that automatically, through unemployment insurance and other government spending, will direct resources to places that are struggling and therefore get them to bounce back. And, of course, we share a common regulatory structure across the country. When the euro was created, none of those conditions was met perfectly. It's hard. While it's legal to move, say, from Italy to Germany to get a job, it's hard culturally because of the language and other things. There was a fractured regulatory structure. And fiscal policy was still held at the national level, not at the euro level. So this was a rocky relationship to begin with. And then, of course, when Greece gets in trouble, as does Italy and Spain and Ireland and some other countries, the typical way to recover vis-a-vis the rest of the world is to depreciate your currency so that your exports feel cheaper to the rest of the world. And that's kind of like putting everything on sale and getting business going again. But once you share the euro with Germany and other countries that don't want to depreciate it, you've lost that tool for recovery. You also have lost the ability to set independent monetary policy. There may be a Reserve Bank of Italy, but they're just doing regulatory stuff. You can't cut interest rates in Italy and keep them the same in Germany. It's one common interest rate across the Eurozone. So what you have is weak countries in the euro unable to use the tools that they would normally use to get themselves out of trouble, and therefore the Greece problem just spirals and gets worse and worse until it becomes a debt problem as well.
This is also interesting. I was wondering how people can actually find your book, and what is your website that you can give out for our listeners today?
The website is nakedeconomics.com, because the Naked Money, which is the book we're talking about now, is the third, and what I guess we're now describing as the Naked Trilogy. First there was Naked Economics, then there was Naked Statistics, now there's Naked Money, but Naked Economics is the website for all of them, and you can get all three books wherever books are sold.
Well, very good. I want to thank you so much for taking the time to be on our program today, and I know that as people pick up your Naked series, they will come to have more clarity about what this is all about and perhaps even make better fiscal decisions than we made back before 2008. Thank you so much for being on the program today.
Thank you. My hope is we'll make more responsible individual decisions, and then when we add that up, we'll also make better government and finance decisions, and we'll all be better off for it.
Absolutely, Charles. Thank you so much for being on the program today.
Thank you for having me.
We want to thank you, the listeners out there, for tuning in. You can also discover more by visiting us at Beyond50Radio.com. You can sign up for our weekly e-news updates, stay up to date with what we're doing here on the radio show. You can also follow us on Twitter at Beyond50Radio as well as Facebook. I'm Daniel Davis. Thank you for tuning in. This is the Beyond 50 Radio program, and remember, live your day past halfway.